Today's webinar is worth 1 CPE credit. To be eligible for today's CPE credit, you must answer 3 of the 4 polling questions offered during the webinar. CPE will be available in 7 to 10 business days after the webinar. We are unable to grant CPE credit in cases where technical difficulty preclude eligibility. CPE program sponsorship guidelines prohibit us from issuing credit to those not verified by the technology to have satisfied the minimum requirements as stated. In accordance with the standards for the National Registry of CPE sponsors, CPE credit will be granted based on a 50-minute hour. I'd also like to remind you, if you do have issues with the polling questions, please answer in the chat. And if you have further questions with the chat, please send me an email. We'll be sure to get you the CPE credit that you've earned today. And now it is my pleasure to welcome Jill Nussbaum. Jill is the Professional Development Chair of the Twin Cities chapter and the Engagement Director of Clifton, Larson, and Allen. Welcome, Jill.
Thank you, Nancy. On behalf of FEI, I would like to welcome all of our members, strategic partners, and guests who are joining us today. We're delighted that our strategic partner, CIBC, is joining us to share insights on the current economic outlook. Before we kick off today's program, I'd like to make you aware of just a couple of upcoming virtual programming events. Join us on March 3rd when our strategic partner, Baker Tilly, shares key elements of transforming your finance function from reporting-centric to business analysis-centric. And join us also on March 9th when George Murray, expert networker and author of Hired, and FEI board member Karen Blasek discuss the power of networking and also share strategies and tactics for how to be successful in any situation. You can register for these events and more at feitwincities.com. And now I have the pleasure of introducing Brock Peterson, Managing Director, National Commercial Banking for CIBC. Brock will introduce our speaker and help moderate today's program. Brock?
Yeah, thanks, Jill. Thank you for the introduction. As Jill said, my name is Brock Peterson, and I work in the Minneapolis office of CIBC here. And just for those who aren't familiar with CIBC, we're a 150-year-old financial institution. We focus on banking middle market companies here in the Twin Cities area, in addition to the Minnesota and Dakotas markets. And we focus on cash flow and asset-based financings for mergers and acquisitions, shareholder events, different types of financings and general corporate purposes. I will say we're a new sponsor for a strategic partner, I should say, for FEI this year, and we're very excited to be able to present the economic outlook here today for FEI and all the members. So again, we really appreciate you inviting us, and look forward to the discussion today. I will say, introducing Benjamin Tall is always a pleasure. He's just a joy to listen to, and so we're in for a treat today to hear about Mr. Tall and his economic forecast here for 2021, and look forward to again his conversation. So with that said, I think you've all heard or been able to read the bio on the website. For those who haven't, it is listed out on the website, but Mr. Tall is frequently solicited to have conversations around the economy, not just in the U.S., but the global economy and Canada as well. So please welcome, virtually at least, Mr. Benjamin Tall.
Thank you very much. A lot to talk about, of course, and not enough time. I'm going to share my presentation. I hope you can see the presentation. The title is After the Winter. So again, so much to talk about, not enough time. So I will go through this presentation relatively quickly. So please pay attention. After the Winter, it's actually a poem that was written in 1992 by Claude McKay, and basically a very optimistic poem about something better after the winter. I will share that vision. I believe that the second half of the year is going to be a very strong period of economic growth, and I will tell you why in a second. I will try basically to answer three questions in this presentation. How bad is the winter? We know it's bad, but how bad? Maybe not as bad as it could have been. How strong will the rest of the year be? I think it will be very strong. We'll discuss why. And the most important question, any scarring, namely, to what extent we are going to see long-term impact due to COVID-19. Another way of asking that question, to what extent COVID-19 is an event or a condition with major implications we'll discuss. But before we do all that, Nancy, I think that's the time to ask the first question.
Thank you so much, Benjamin. Yes, your second poll is up on the screen at this point. Do you anticipate a stronger economy in 2021 versus 2020? I'll give you just a few moments to answer that easy poll. For those of you who might have had difficulty, again, the poll, if you can let me know in the chat if you have any issues at all, and I'll make sure you get the credit. All right, we have almost all our answers in. Another second or two, and I'll show you those results. All right, here we go. 88% think, yes, we're going to have a better year. Take it away, Benjamin. You let us know we're sure.
88%, that's very encouraging. A good reason to believe so, because quite frankly, 2020 was nothing to write home about, economically speaking. So it's relatively a very easy target to surpass. And I think that we have to put this in perspective. So let's discuss the first quarter, the next few months, the winter. The winter is tough, economically speaking, but there are some positives in the negatives that make the situation much better. One of them is actually the fact that we are not shutting down the economy despite a second or even a third wave. We have learned to live with this crisis everywhere. You can see that the level of closing down the economy is much lower than what we have seen in March or April of last year. So we are able to continue to function despite the fact that we are in a second wave, totally different than what we have seen in the spring of 2020. That's number one. Number two, we are much more equipped to deal with online abilities. Namely, we are more able to do so. Namely, business is much better than, let's say, March or April, that we didn't know anything. We are much more productive now than last year. Listen, I can find the mute button in Zoom. That makes me automatically 20% more productive. We see it in construction. We see it in manufacturing. We were able to maximize productivity given social distancing, something that we haven't seen in March or April of last year. That's another positive in the negative. Then we have confidence, more risk-taking. I talk to many CEOs, and I can tell you, companies are willing to take risks now because they see the light. Yes, we can debate how quickly this light is arriving, but it's arriving. March, April, nobody was even dreaming about taking any risk given the uncertainty. So that's another positive. And then we have fiscal policy, a huge boost. And we'll discuss fiscal policy in a second, but $1.9 trillion can buy you a lot of things, especially time when you need it, given the situation now. So that's basically the positives and the negatives. Let's discuss fiscal policy, and let's discuss the Biden administration and its implications in the short term, economically speaking. And what I see is basically Biden light. Namely, you will not be able to get everything that he wants, but he will get something. COVID-19, we are talking about $300 or $400 billion of money going into vaccination. That's one of the reasons why the US is doing so well in terms of the rate of vaccination, better than many other countries. Stimulus bill, you know the story, you read the newspapers. We are talking about potentially $1.9 trillion of money getting into the economy soon. That's 10% of the economy. We have never seen anything like that. That's huge. And that can buy you a lot of activity, and it's going to replace income, it's going to PPP, and it's going to local governments. Very, very important. Yes, Biden has a $3.1 trillion of taxes or raising taxes plan. Not going to happen anytime soon. Nobody's in the mood to raise taxes at this point. This is a 2023, 2024 story, not anytime soon. Infrastructure, $2.1 trillion of new money going to infrastructure. About 800 billion of it will find its way to transportation. The rest will go to green, with major implications as far as the productivity of the economy is concerned. Nothing in 2021 probably, but that will be a 2022 story. Immigration is opening the gates. You will see a significant increase of new immigrants entering the country with, again, very important economic implications. Energy, negative, clearly negative in terms of regulations on the oil sector, and that's something that we have to be ready for. That will happen very quickly. And trade policy, it will be a continuation of Trump to an extent. We see the emergence of two trading blocs, a semi-Cold War with China, and you will see Biden going after China, but he will do it as a coalition with the Europeans, with the Canadians, very different than what Trump was doing, basically doing it by himself. So it's going to be more effective, maybe more polite, maybe more muted, but the direction is the same. The emergence of two trading blocs, I estimate that about 20% of what the US is now buying from China will come back home. About 20%. So it's not the end of globalization as we know it, but clearly some element of deglobalization that started with Trump and will continue with Biden. Now, let's talk for 2 minutes about the virus. Now, I know that all of you are sick and tired of hearing about the virus, but believe me, the virus is not tired of infecting us. So we must understand what's happening. And that's the situation in the US at this point. For a given level of infection, the US, since the beginning, was much more open than most other OECD countries. The positive spin, well, the economy is doing better. The negative spin, the infection rate is higher. So if you wish, the conflict that is defining this crisis, the conflict between lives and livelihood, is in full display here in the case of the US. And now what Biden is trying to do is to get this red dot back to where it belongs with some economic damage, and therefore you need the injection of government money that is coming very soon. That's very, very important to understand. Clearly, you cannot talk about the virus without talking about the vaccine. The US is second to the UK when it comes to the speed of vaccination, and the US is now closing the gap. We are seeing the vaccination rate actually doing better than what Biden promised in the first 100 days of his administration. That's extremely important. That will continue. So we are very optimistic about the US able to get to its target of about August, September. I think it's doable, moving in the right direction. And the good news, it's very symmetrical. Namely, you see it everywhere. It's not just one side of the country, one state. It's everywhere. It's very symmetrical and it's very balanced, something that will help the ability of the economy to grow when we reach the other side of this madness. So that's more or less where we are. So short term, clearly not great. Second wave, maybe a third wave coming, but there are some positives and the negatives, and I see actually some positive GDP growth, although relatively low in the first quarter of the year. That's the short term. Beyond that, the spring and then the summer, I suggest that we are going to see a significant improvement in the economy, and I'll tell you why. First, the nature of this crisis. The damage due to COVID is very, very deep. If you are impacted, you feel the pain. The damage is deep, but it is also very narrow relative to any other recession. Namely, the number of industries that are fully impacted is relatively small compared to any other recession. Today, we have 2/3 of the economy in a full swing V-shaped recovery, but 1/3 is still stuck in this L-shaped recovery. And if those industries and businesses were unable to recover during the happy days of summer, surely they will not be able to recover during the long days of winter. But what it means, it also means that when we see the other side of this crisis, it will not take too much to see a full recovery because the number of industries that are involved is relatively small. That's very important. That's number one. Number two, the nature of this recession. It's all about services. This is a service-oriented recession. All the damage was in the service sector. In fact, goods are up because you press a button and you get your exercise bike, no problem. The issue is restaurants. The issue is hotels. The issue is airlines. We all know the story. So that's where the damage is. Now, that's the bad news. The good news is that a business that is in the service sector can recover very quickly relative to manufacturing. Basically, it is much easier and faster to start a new restaurant than to establish a new manufacturing facility. So the speed of the recovery will be much faster relative to any other recession. So you have two factors here. One is a situation in which the damage is very deep but narrow, and then you have a very rapid recovery in service-oriented businesses. And then we go to the other force, and that's income and cash. The abnormality of this recession is demonstrated in this chart. High income employment, high wage employment did not go down at all. Almost all the damage in the labor force was witnessed and experienced among low wage occupations. This has major implications. If there was an income gap before the crisis, now it is much wider. But it also means that most of the decline, in fact, all the decline in spending, in consumer spending, was among high income individuals. That's fascinating. We have never seen it in any recession, but that's exactly what's happening. And if you think about it for a second, it makes sense. Because low income individuals, they spend most of their money or government money on necessities like rent or food. High income households, they are the ones that are not spending. At the same time, we have a situation in which their employment is still there. Their income is still there. So their income is there, in fact, rising, but their spending is down. So we see their savings rate rising at a rate we haven't seen before. We are sitting on huge amount of excess cash, sitting on the sidelines, looking for direction. We are talking about close to 11% of consumption now in excess savings, more than it's supposed to be in normal times. And after the $1.9 trillion coming, this number will rise to close to 17, 18%. That's a huge amount of money that people are trying to get rid of. This is not that they are scared. They're simply unable to. Listen, people are dying to go to restaurants, but they are not willing to die doing so. So this is a huge amount of money, pent-up demand that is looking for the green light. And when we have this green light in the second half of the year, this money will be utilized, it will be spent. And officials are asking me, how can we convince those people to spend their money? And I said, provide the vaccine and get out of the way. This money will be spent. They just need the green light. This will be a major boost to economic growth in the second half of the year. So we have three factors here: deep and narrow, the service-oriented recession that will recover fast, and then we have the cash factor that will be spent the minute we have the license to do so. That's huge. So that's another factor why the economy will continue to grow. In addition, we have wealth. If you look at the wealth position of Americans now. We are seeing the stock market almost whole new highs. We all know the story. We see the housing market doing fine. So clearly, total assets rising much faster than liabilities. So people are richer and wealthier. Also, if it's not enough, you have low interest rates that are leading to a significant increase in mortgage refinancing. And none of it is really cash out refinancing. It's basically better terms, saving money, another positive factor here. So there are many things happening at the same time, supporting the consumer, and will lead to a significant increase in consumer spending the minute we have the green light. And at the same time, you have the construction sector, the housing sector doing extremely well. In fact, confidence, home builder confidence is higher now than it was before the pre-financial crisis peak. Unbelievable. The only thing that is impacting their mood now is the cost of lumber that is rising dramatically due to huge demand for housing in the US. So that's extremely important. And then investment is doing much better than in any other recession. We are in a full swing V-shaped recovery in investment relative to any other recession. This is very, very quick. Why? Because most of it is in high tech, which is now 50% of total capital spending in the US. So that's something that to me suggests that we are in an environment in which after the winter, we are going to see a significant improvement in economic activity for many, many reasons, including the cash position that will be there. Now, I will stop here for the second question, Nancy, and then we'll continue.
Thank you so much. The third poll is on your screen. Do you project your business to have a stronger year in 2021 than 2020? I can tell you already that this is a very positive group of people. I'll give you just a few more seconds, folks. I know we have about 50 of you doing polls. All right, I'm going to end that poll. Thank you. And I'm going to share those results for you, Benjamin. Look at that.
Wow. Yep, good.
Mm-hmm.
Okay, so let's proceed and see what makes sense and what doesn't from this point. Now, there are two issues that I would like to discuss, and one is this, the American dollar. We have seen a significant decline in the value of the Canadian dollar. I know that people in the market are a bit concerned about it, and I say put it in perspective. Relative to some other periods of dollar weakness, this is really nothing to write home about. So from a macro perspective, given the fact that the US is not really relying on trade, and the fact that the US is really an economy that is relatively closed compared to many other economies, including the Canadian economy, or the Mexican economy, or even the German economy, we have a situation in which the dollar decline so far is really not significant enough to have a major macroeconomic story. So it's a market story, it's not really a major macro story. That's one thing. So if you sum up all those forces, you see an economy that will grow in the first quarter by about 1 or 2%, and then will jump to about 4 or 5% when we get the numbers or the $1.9 trillion from Biden. And then in addition, the spending by consumers, the cash factor, and the recovery in the service sector suggest that the rest of the year will see an average growth of 5, 6, 7%, very, very strong growth with major implications. Now, all this is wonderful. We are talking about a significant improvement in economic activity in the second half of the year. We see the Fed printing money, the government injecting a lot of money into the economy. So what does it mean? Now, if you are under the age of 30, you are probably not familiar with the next term that I'm going to introduce. It's called inflation. You probably don't know what it is because it has been missing in action for 30 years. So just to make sure, I checked at the Oxford Dictionary, and it's still a word in the English language, inflation. And the key question, of course, is that we have the government spending like there is not tomorrow. We have the Fed printing money. And in Economics 101, they are telling you, when you do that, you are getting not only inflation, you are getting hyperinflation. So I believe we need to discuss it, because I'm sure that all your businesses will be impacted if tomorrow we see a significant increase in inflation. And clearly, the long end of the curve, the 10-year rate, rising to 1.3%, is starting to tell you something about inflation. So we have to discuss it and see what makes sense and what doesn't. First of all, let's discuss money supply. In the past, money supply was the #1 predictor of inflation. And again, in Economics 101, they will tell you, you want to see inflation? Look at money supply. That's the predictor. Look what happened in 2008. Now, this is very important to understand. 2008, as you know, the Fed was printing money, quantitative easing. Money supply did not rise. Now, why? Very important to understand. The Fed was removing bonds from the market to keep their rate low, put them in their balance sheet. This money went to banks. Now, banks got the money, took one quick look at the subprime economy, and said, you know what? I'm not lending in this environment. I'm not lending. I'm not interested. So they took this money and sent it back to the Fed and collected 15 basis points interest rate on that. So the money left the Fed to buy those bonds and then went back to the Fed under reserves, which means that it did not go to the economy. And that's why money supply did not rise back then. Today, the government is issuing bonds. The Fed is buying bonds from the secondary market to allow the government to do so. The balance sheet is growing, and some of this money is finding its way into the banking sector. However, in order to see inflation, you need this money to be used. Namely, in order to see inflation, you need not only money supply to rise, it's there, it's going to deposits, but you need people to use that money. We call it the velocity of money, the rate at which money is exchanging hands. And as you can see from this chart, money supply is rising, but also savings are up. So people are not using this money. And therefore, if you look at the loan to deposit ratio, banks are not lending relative to the amount of deposit that they have. And therefore, at this point, this is not inflationary. Clearly, there is some element of temporary inflation that are starting to impact the psyche of the market. And let me explain. Look at this. This is very important. If you care about interest rates, if you care about the 10-year rate, pay attention to this chart. The red line is the 10-year rate, and it's up to 1.3, as you know. Until just a week ago or so, most of the increase in the rate was due to inflation expectations. People have basically upgraded what we call inflation compensation or expectations. But as you can see over the past week or two, the 10-year rate continued to go up while inflation compensation expectation went down. So they are stabilizing now at inflation expectations of about 2%. But the 10-year rate continued to rise because at this point, the market is focusing not on inflation, but rather on the move by the Fed. If the Fed starts moving, that can lift the 10-year rate, and that's what is priced in. So it's not just inflation, now it's the move by the Fed, namely the increase is starting to impact real rates as opposed to nominal rates. And that's something that we have to take into account. And as you can see, the market is already pricing in higher probability of the Fed moving earlier. So far, the official communication from the Fed is that they are going to raise interest rates in 2024. The market now is disagreeing because of that and pricing in a move in August of 2023. I believe the move will be even before that. It's not unthinkable that the first move by the Fed will be in the fourth quarter of 2022, or maybe the first quarter of 2023. And I think that the market is starting to realize that. So between some inflation expectations and increase in the likelihood of the Fed moving earlier, we have seen the 10-year rate rising. That's very, very important to understand. That's the dynamics that we see in the market when you read the newspapers and look at the 10-year rate. That's basically what you really need to understand, in my opinion. Now, talking about long-term rates. At one point, if the Fed is not touching short-term interest rates, but long-term interest rates rise and the yield curve is steepening, that will be counterproductive because that will derail the recovery. So what we are going to see is the Fed either buying more bonds to make sure that the 5, 10, 30-year rate will remain relatively low, or they will introduce something called yield curve control, like the Bank of Japan is doing now, where you set a target for the 30-year rate, for the 10-year rate, and you say, that's a target, I will buy and sell bonds to make sure that that target is maintained. We call it a yield curve control. They will not do it now. They will do it, let's say, if the yield will reach about 1.7, 1.8. But we know that at about 1.3, we are getting very close to the point in which the psyche of the bond market is starting to impact the psyche of the stock market because the discount rate is starting to rise a bit too much. So inflation is very important here. My opinion is that we are going to see some inflation in the second half of the year, because if I'm right, or even semi-right, and so much money will be chasing a lot of services, that will lead to some inflation in services. But the Fed is telling you one thing: we are willing to tolerate higher inflation down the road for a short period of time and not to derail the recovery by raising interest rates prematurely. So they are going to target what they call average inflation as opposed to spot inflation, and they will allow to a situation in which they target the long-term average. So you can have a situation in which you have 1 year with or 2 years with 1% inflation, another 2 years with 3, the average is 2, and they are happy. So that's very different than any other recovery when they started to raise interest rates prematurely. That's the situation. So remember, inflation is coming, maybe in the service sector. The Fed will tolerate it because they will view it as a blip, and the bond market is already adjusting for that. That's more or less where we are. Very, very quickly, the last question is scarring. To what extent we have long-term damage due to COVID, namely an event or a condition. A good example of a condition is the 2008 crisis, as you can see from this chart. What happened, the red line, is that we have seen a decline in economic activity in 2008, fine, but then look what happened. The speed at which the economy was growing after the crisis was lower than the speed we have seen before the crisis. This is a structural scarring, a structural change in the dynamics of the economy that led to reduced speed limit, reduced ability to grow. And the question is, to what extent that's the situation now? To what extent COVID is an event or a condition? My answer is that economically speaking, I believe that COVID-19 is an event. Yes, we will have to live with this virus for a long time. I guess every year we'll have to get a new vaccine, whatever, it will be with us. But economically speaking, we will learn to live with the virus. Surely there are some permanent changes. E-commerce accelerated and will continue to be elevated. More people are more comfortable with e-commerce. The office space, although I don't think that we should exaggerate the impact, is going to change a little bit. You know, when you're in a crisis, you tend to exaggerate the long-term impact of this crisis, and we are in a situation. So I think that we should be careful not to project these changes to be permanent, although some of them will be there. But I suggest that we haven't lost any production capacity during this recession. We haven't lost demand. We haven't lost the ability to finance that demand. We simply need the green light, and the means to finance this spending that we're going to see is there. And the nature of the recession also is telling us that the recovery is going to be relatively strong. So I see it as an event as opposed to a condition. And just to illustrate this point, let's look at those pictures from 1919. That's only 1 year removed from the 1918 Spanish flu. New York, London, like nothing happened. I suggest that with the vaccine, I believe that in a year or two, our life will look exactly like that. I will stop here and see if we have times for Q&A. Thank you.
All right, do we have, remember to use the Q&A function? I see we have one question in there, or certainly just type it in the chat function for those who can't find the Q&A box there. But the first question we have here, Benjamin, is, are you concerned about economic bubbles? And that's from Willard.
That's a good question, and absolutely, we always have to be concerned about bubbles. The question is whether or not we are creating one now. The only bubble that I can see at this environment is the bubble that we have seen to an extent in the bond market, if you wish, but I don't see it as a bubble. I see it as a reflection of the situation, the fact that we were in a crisis, we are in a crisis, and we had to cut interest rates to basically zero with major implications on the bond market. Bubbles can happen everywhere. You know, clearly some aspects of the stock market is a bubble. You know, I don't think that the stock market as a whole is a bubble, but to what extent Bitcoin is a bubble, you can argue that yes. I think that the interesting story about Bitcoin or this kind of technology is not the coin itself, is the technology. The technology is interesting. The coin is not very interesting to me. So yes, some elements of bubbles there, but as a whole in the economy now, I don't see a bubble.
Great. Thanks. We have another question here. With so many people working from home, what are your thoughts on the impact to the commercial office real estate markets?
Yeah, that's a very good question and a very important question. Again, I suggest that we should be careful not to exaggerate the long-term implications of this crisis. Clearly, there is a structural change in working from home, and it will happen. We can not 5 times. Maybe the concept of rush hour is becoming primitive. Who says that you have to be in the office at 9 o'clock? But the office will remain very, very important. There will be some reduction in demand for office space, but not as much as perceived. We already have seen a huge number of companies telling us that they will require their people to go back. That's one thing. Then we have seen a situation in which people actually moving to the suburbs, 2-hour drive from their office because they believe that they will be working from home. First, it's a big gamble. And buying a house there, it's a big gamble. Second, maybe your current employer will allow you to do so. What about your next one? Which means that this can actually impact labor mobility with negative implications. So I suggest that the damage to the office space will be there, but it will not be as significant as perceived, and I will not exaggerate the impact of people working from home as a permanent situation that will change the face of the office space. I don't think that will be the case.
Okay. Another question from Mark. What effect will raising the minimum wage to $15 have?
That's a very good question. And I think that we have to make sure that we don't do it too quickly. And I know that there is a timetable. There will be an inflationary impact, clearly. And I think that that's something that is already in the psyche of the bond market when we have seen the increase from less than 1% to 1.3%. And we might see future increases in the long end of the curve reflecting this kind of inflationary factor. The speed is extremely important. It's not the level, it is the speed. If you do it too fast, you can really derail many small businesses. So it's a very, very tricky situation, inflationary-wise, and the impact on small businesses.
Got it. What are your thoughts on potential hotspots today, such as North Korea, the Middle East, etc.?
Yes, my focus is on Iran at this point. To what extent what's happening in Iran will have significant implications on oil prices and the relationship between the US and Iran. I don't think that people are really have any appetite now to escalate the situation. So I see a little bit of a status quo with Biden moving very, very slowly on Iran. China worries me. The relationship between China and the US is a major issue. We are in a Cold War type situation. As I suggested, I see a significant amount of export or import, US import coming back home. That's very important. And I do believe that you will see some sort of the emergence of two trading blocs that will make the situation worse. Many countries, small countries that have to choose a side, will have to choose a side. If you're Canada, you know where you are. If you're Australia, that most of your security needs are coming from the US, but your economics needs are coming from China. What do you do? Good luck with that. So to me, this is a major issue to monitor. So yes, there are a lot of, I think that Biden will go very slowly on them. So you'll see status quo for the next year or two without people really moving too rapidly on that.
Okay, thanks. Another question here from Brian. What effect will energy, speaking of energy, regulation affect jobs? Do you think it'll reduce or add to the number of jobs?
Unfortunately, I think it will have a negative impact on the energy sector in the US. I cannot see it other way. I think that Biden is very serious about the energy sector. Those jobs will be lost first, and then the green jobs will come later. That's the nature of the crisis, of the situation. So I think that, yes, the short-term impact on US energy will be negative, unfortunately. So I see a lot of M&A activity. I see the energy sector actually becoming smaller, more productive, more efficient, even greener, but smaller.
This one is from Brad. What do you see driving the strength of the CAD versus the US dollar, especially when the usage of Canada fuel by the US has declined due to the work from home trend?
Yes, I think that the most important factor is not really a Canadian story. It's really an American story. It was the general weakness of the US dollar that led to the appreciation in the value of the Canadian dollar. Nothing more than that, quite frankly, as we have seen it with other currencies. Now, clearly, this is a major issue in Canada at about 78, 79 cents. Canada has no business being in this level. It's very expensive as far as Canada is concerned. And the Bank of Canada will tell you that they don't have a policy regarding the dollar. They don't have a dollar agenda. In fact, in a speech, the governor of the Bank of Canada said, "We do not have a dollar agenda. The dollar is off the table." That's what he said. And I say it is never an official policy until somebody officially denies it. I think it is a policy, and I think they would like to see the dollar going down. And that's one of the reasons why we believe that the market thinking that the Bank of Canada will move before the Fed is wrong. The Bank of Canada is expected by the market to move a full year ahead relative to the Fed. I'm not sure what the market is smoking. It's not going to happen. And I think that's something that they will actually try to do the opposite. They will try to wait until the Fed is moving in order to lower the value of the dollar a little bit.
Great, thanks. This one question is from Suzanne. Any thoughts on supply chain balancing? It seems we're struggling with smoothing it out.
Yes.
If the economy improves as we predict, we may be constrained by this challenge to meet demand.
Absolutely, and that's one of the reasons why I believe that inflation will be an issue, at least short term, until we go back to semi-normal. We have to remember that if we are in a deglobalization period, if globalization was the disinflationary, deglobalization by definition can be a bit inflationary, and that's something that can impact the cycle of the market. I totally agree that we are going to see some supply chain issues, but I think it will be short-lived. I don't think that's something that will determine the agenda over the next 5 to 10 years. I think that the trade with China will be much more important. But also I see, especially in some industries like high-tech, defense, healthcare, you will see more activity coming back home. And what Canada is trying to do, by the way, is to convince Biden that buy Americans, actually buy North America. That's more or less where we are now.
Great. This question is from Robert. With such low interest rates on mortgages and accompanying demand for new construction, do you feel that home prices are getting ahead of themselves?
I think that we are going to test the resistance level when it comes to house prices. Home prices are a bit too expensive at this point relative to income. And clearly, that's what's happening with low interest rates. We see it everywhere. So talking about bubbles, I don't think it's a bubble, but it's creating some early stages of affordability crisis that will lead to some sort of regulations into it. So I suggest that, yes, you're absolutely right, that there is we're in a very early stage of affordability issues related to extremely low interest rates. We have to remember that almost all the jobs were lost in low wage occupations, as I suggested. Now, they are renters, which means that the housing market was doing so well because a very large segment of the population was untouched financially by the crisis. In fact, they are doing better and interest rates are in the basement. That was their opportunity to enter the market. That's very different than any other recession. And in this sense, clearly you're creating a bit of demand that you cannot be justified under a different scenario.
Great. This question is from, let's see, this one is Willard again. Do you see manufacturing coming back to the US?
The short answer is yes. Not all of it, of course, not T-shirts and not low value added manufacturing, but I definitely see high tech. I see health. I see defense related coming back to the US. Again, 20%, that's our assumption over the next 5 to 10 years. Not a game changer, but clearly something at the margin. I think that the experience with China and this crisis will lead to some more permanent changes when it comes to trade.
This one's a little more close to the time relevance, I should say. What areas of the economy will be affected and for how long due to the Texas electrical issues? Shortage of beef?
Yes, that's a very tough one. We really haven't looked too much into it. I think it will be a very short-lived. So this, from our perspective, is not a macroeconomic story because whatever you lose now, you will get next month. So from a quarterly perspective, this is basically a zero-sum game. Although, of course, people in Texas will not feel this way at this point. But from an economic perspective, this is an event like many other events in the past that will go down and up. From a quarterly perspective, it will not change anything.
This one is from Dennis. What near-term tax changes do you see happening in both business and individual income taxes, perhaps to assist paying for all the spending?
Listen, we know that Biden has a very clear tax agenda. We're talking about roughly $3.1 trillion. It's only a question of timing. He's going to implement an element of it. He's not going to implement all of it, but it's not going to happen anytime soon. Quite frankly, I don't see it happening in 2021. I would be very, very surprised if anything happened in 2022. To me, it's a 2023 story after you are safely removed from the crisis.
Okay, and the last one that I see as of now is a question: with so much of the economic damage falling to low wage workers, what are your thoughts on how BIPOC populations will fare after the winter?
I think that if you look at the nature of the recovery, and if you look at where the spending will be coming from and where it will be going to the service sector. And one of the reasons why I believe that the recovery will be relatively strong is because of that. I believe that you will see a situation in which the money that is now being sitting in checking savings account will be spending not on goods, on the service sector. So the people who were impacted will actually be benefiting from this spending. So the money will be going to the right place, which is the service sector, creating jobs in this environment. That's more or less where I see the contribution.
Great. I don't see any other questions at this time. If there are, please, maybe take the next 10 seconds, type them in. We'll give that another few seconds here.
Excellent. While we're doing that, I'm going to pop in and offer our last poll for our audience. And it's a hard one. Yeah. And if you do need more information, obviously the partner CIBC is here to help. And I think there's a Bitcoin opinion in there.
Yeah, the last question in here is, what's your opinion on Bitcoin?
Yeah, that's a good one. The way I look at it is the following. There is the short-term story, namely the currency itself, the value of Bitcoin, cryptocurrencies in general, which I'm very not interested in because it's a bubble. It's not really a storage of any value. It's just people playing games, which is fine, legitimate. I'm much more interested in the structure of the market and how Bitcoin and crypto is going to change it, and it will. Banks are interested in Bitcoin and cryptocurrencies. They are not interested in the currency, they're interested in the technology. And this technology will be part of what they do in the future. Same goes with Apple or Tesla or governments. That's happening. So from a long-term perspective, this is the very beginning of the demise of the US dollar as a major reserve currency. I don't think we'll see it in our lifetime that the US dollar will not be a major currency, but it's the beginning of a change in the status quo given the structure of the US dollar. That's one thing. The other is that banks cannot hold Bitcoins or any other cryptocurrencies because of the changes in valuation. It's simply too volatile, so no bank can do that when you have to mark the market on a daily basis. That will lead to a situation in which you cannot detach the currency from the technology. At one point, it will happen. How do you do that? You regulate. So I think you will see a wave of regulations coming to this space to make it a legitimate part of the system. And if you look at Yellen, she likes two things: big government and regulations. So it's coming.
Yeah, a couple of questions came in, and we do have time, so this is great. You know, speaking on a similar topic and very time sensitive. You know, the GameStop situation. You know, in the last few weeks. You know, how will that impact the stock market going forward?
So far, the stock market as a whole has been an observer to this craziness. It's not part of it. And as long as it's not part of it, and as long as what's happening there did not impact the psyche of the market as a whole, to me, it's interesting, but that's it. So I think that was a big test that we passed, that the market was not part of this, you know, craziness in the market. Now, I don't know if we will pass next time, but the fact that it's happening is extremely interesting. But so far, the market has been an observer, and that's what I'm doing.
Yeah, that's definitely a time-sensitive one on all of our minds, I think, for sure. So thanks, Benjamin. Let's see, one last question here. To what extent do you think that labor availability will be tighter with lower wage workers retaining into higher value occupations?
That's a very, very good question. And we are going to say a lot of things. Listen, for example, if you look at the unemployment rate in the US at about 6.7, the real unemployment is much higher because A, they're not counting discouraged workers. Second is that many people left the labor market because they don't have daycare and they don't want to get sick. The minute you have the green light to go back, you will see a significant increase in the number of people returning to the job market. Many of them will be low-wage jobs, but they will be there. And I suggest that that's something that will make the unemployment rate difficult to improve during the recovery. So you will see more people entering the labor market, and the unemployment rate will not be falling in a very significant way. That's something that we have to expect. The increase in the minimum wage is a major factor that will lead to some wage demand in higher wage occupations because of the nature of this trajectory. So that's something that is going to happen. So the labor market in the US after the crisis will be a very dynamic place, and working from home will be a part of it, but it will not be the whole story.
Great. Yeah, we have 5 more minutes and some more questions have trickled in here. So if there are tax changes, is there a chance of it being retroactive?
No. Absolutely no, he's not going to do that.
Okay.
All the things that he's talking about are very clear. We know exactly what he's going to do. The Senate, the Congress will not allow him to do everything that he wants. He will get part of it. I believe that none of it will be retroactive. It's simply not a good policy.
All right, another one. How will a reduced international political standing of the U.S. affect the economy, if at all?
That's a very good question. I've been thinking about it a lot. And my answer is that not in a very significant way. There is a big difference between what people talk about the US in terms of the political agenda, the umbrella, the defense coordination. When you translate to economics, the impact, at least in the short term, is not really there. And then you have Biden trying to reverse most of it and getting the US back into the Paris Accord and into the environmental aspect. So I don't think there is going to be a lasting significant damage.
This question is from Roseanne regarding hiring trends. I don't think it says we haven't covered that. Do you anticipate any changes to how we recruit talented workers?
That's a tough one. I think that the most significant change will be on the social safety net following the crisis. I think that the crisis exposed the vulnerability of the US economy, the income gap, the fact that so many people fell behind with no assistance whatsoever, relying on the government. I think that what we are going to see is more money being spent on assisting those people in the future, the gig economy that is going to be a very big part of the economy. How do you take care of them in terms of unemployment insurance perspective? I think that will be the more important change, not the way we're going to hire people. That's my opinion.
Great. Maybe this will be the last one here from Mark. How much of a threat to the economy do you perceive from cybersecurity, hacking risks, etc.?
It's significant. I think that if I lose sleep over something, it's over that. And I'm almost convinced that the next crisis will be related one way or another to cyber. I just cannot tell you how, but to me, this is a major issue. And it's a back and forth between people who want to do that and people who are trying to defend us from that. It will happen. And hopefully it will not be too severe, but I think it's coming.
Great. Well, I think that might wrap up the presentation and the Q&A sessions. We get everyone out of here by 1 o'clock. I just want to say again, thanks to everyone for listening to Benjamin and logging in. And again, on behalf of all of CIBC here in the Minneapolis office, we certainly are looking forward to getting to be more of a part of the strategic partnership with FEI this year. So again, thank you all, and look forward to hopefully seeing everyone at some point in the future in person. So.
Okay, thank you very much. Bye-bye.
Thank you, Brock. Thank you, Benjamin. This does end the webinar. I've had a lot of comments come through. Great presentation, great job, excellent. We do appreciate your thought, knowledge, and sharing with our FEI members. We wish you the best of the afternoon, folks, and have a great day. This does end the webinar.